good? What's good? What's good? I'd like to welcome everybody to another episode of Financial Bars. It's your host of Rappin, Don Bucks, and I'm just tapping in once again. You know what day it is, man. You know what day it is. I hope everybody came with a pad and pen so you can take a few notes. Give you something to go with for the rest of the week, because this is where we have money conversations, particularly the stock market and business, to be exact. But first, I'd like to start with my disclaimer. I got to give my disclaimer. I am not a financial advisor. I am not a fiduciary. I am not a money manager. But I know what I know. I'm self-educated. And this is for entertainment and educational purposes only. I cannot be held responsible for your wins or your losses in the market if you was to take advantage of anything that I put forth this evening, or any other evening for that matter. So I like to put that out there because we live in an age of lawsuits and things of that nature, and I ain't got time. But I like to start off by also saying that I had a conversation this week, and a person brought to my attention. He was like, "Yo, man, I love what you're doing for the people, for the culture, and whatnot. But you know what I'm saying? He's like, man, you should only get that information to people who want to hear it." So I said, "You're right? But we also live in a day and age where I can reach more than one person by having a general conversation with somebody. I can reach more than one person by recording it live, posting it on YouTube. Because me personally, I get gratification from somebody taking advantage of this stuff and building wealth for their family and their future. You know what I'm saying? One person get back to me like, "Yo, Don," like from 10 years later, get back to me like, "Yo, Don, because of all that information you put us up on, my family is financially set for the rest of their life," or whatever the case may be. That's the only reason I'm in this. You know what I'm saying? I just get personal gratification for giving information, and I think that's we coming to the forefront with that. We starting to spit game. We starting to put out game. We got a lot of thought leaders out here besides myself that's putting forth game. So we getting there, and I'm just doing my part for the culture. You feel me? Because my perspective of the money markets and the stock market is that I think we should have been taught this in high school. I think we should have been taught this in grade school, because the more and more you get into it and you learn, you realize that this is the way to build wealth. Prime example. If you got any type of good job, whatever, I don't even know if that might be an oxymoron, good job. But if you got a good job, I'm assuming you got a 401k. But what's a 401k? Right? What's a 401k? Because we run around, a lot of us say that we don't know anything about investing, they don't know anything about the stock market and whatnot, right? But what is a 401k? Right? 401k basically is a tax-deferred account for your retirement that your job sets up for you. And what is that? They invest your money into the stock market, right? So if all the companies, all the good jobs in the world, in the country, does this for their employees, what do you think about the stock market? Don't you think it's a good idea that you invest your money? They do it, right? They do it for you, for your retirement. So if they doing that for your retirement, like automatically, if you have a good job, automatically you have to sign up for a 401k. And if they doing this for everyone's job, isn't that a hint as to, yo, there must be something to the stock market, right? This is what I'm trying to tell people. But let's get into it. I gave my disclaimer. But yeah, let's get into it. So, this week, we had a couple record-breaking events this week. The S&P 500 hit a record high, an all-time high this week, the S&P 500. Um, and that's notable because my thing is, um, I hear a lot of commentary a lot of times, or well, I'm gonna just say not a lot of times, but within the past 3 months when the stock market hit a low, you have people saying, "Oh, the stock market is not a good place to be right now. The stock market is fucked up. The market is messed up," right? But what you need to understand is, since its inception, it's designed to go up. It doesn't stay down long. It's designed to go up. The stock market is comprised of businesses that are trying to grow. That's their whole goal. That's everyone's goal when they're in business, is to grow. And if you have companies that comprise the market, this is what the stock market is made of. Businesses, companies that are trying to grow. So if you're investing your money in companies that are growing, dope companies that show their ability to grow year after year after year, if they have a bad month or bad 3 months or a bad year, it doesn't matter. If they're a dope company, they establish the fact that they know how to grow their business, it's going to do nothing but go back up. So this is not the first all-time high, is basically what I'm saying. There was a high before this, then it was a high before that. So this is a new all-time high. You understand? Does that make sense? Like this is a new high. So since its inception, it always had a new high. So if you invest your money over the long term, your money is going to grow. But what we don't understand is how exponentially, how fast it doubles and triples. This is what I'll be trying to explain. Like, if you can go back into previous episodes, I give you an example of how your money starts growing on top of each other based off of compound interest on your money. So you don't get that same growth. You don't get that same growth from putting your money into a bank account. It's only with the stock market and investing in assets where you get that exponential growth. And one good reason why you want your money in the stock market and in assets is because the dollar, there's this such thing called inflation. So you won't be able to buy the same amount of stuff with your dollar next year than you can today, because next year things are going to cost a little bit more than they did the year before. So if you're still making that same dollar and it's not worth the same next year, you have to somehow outdo inflation. You want to put yourself in a position where as though your money can buy more, not less. And the only way to do that is to outdo inflation. So inflation is usually between 1 and 2%, if I'm not mistaken, every year. So stuff is 1 to 2% more than it costs the year prior. So on the average, your money grows 10% in the stock market. So you're ahead of the game 8 or 9% if you put your money in the stock market by the next year. The next year, inflation go up 1-2%. Okay, that's okay, because my money made 8 to 9%. So you're ahead of the game. 8, 9, 10%. You're ahead of the game several percent by investing your money in assets. See, we get caught up in holding on to the money because that's all we've been taught, is to hold on to your money, save your money. Meanwhile, the money is not what you need to be holding on to just for the sake of holding on to it. You dig? Like, we need to be putting it to work so our money can be working for us. Like, yes, you need to work for your money for X amount of time, but at some point, you need to be putting this money to work so you can outdo inflation. So let's tap in, right? So S&P 500 had that new record high. Another record was the fact that Apple, now I know y'all know that company Apple, because you're probably watching this on an iPhone, iPad, or something like that, right? Apple became the first $2 trillion company ever. The first. It ain't gonna be the last. They the first $2 trillion company ever, and they became that this past week that just went by. 2 trillion. You know what I'm saying? There's a couple companies that's coming right behind them, but $2 trillion company. My thing is, how much of that are you getting paid? Because I'm gonna keep saying it over and over again. As you invest in these companies, you become part owner. You become a shareholder. That means you're part owner of the company. So when they make a profit, they distribute you your profit, your piece of the profit, because you're a part owner of it. So based off how many shares or how much ownership you have in that company determines how much of the profit that you get. So you want more profit, you want to participate in more of the profits, you buy more of the company. But the stock market is by far the easiest, cheapest way to get ownership of a company. And we all know we need to own more stuff, right? Like we see the bodegas in the hood being taken over by other cultures. We see all these industries that we need to be leading, that other people are leading, because we don't own anything, right? For the most part, we don't own anything. But if you want ownership, and you build it over time, buy stocks of dope companies. This is how you do it, people. This is how you do it. And I'm just glad that I got a hold of this information before it was too late. So now I could pass it on to my kids, I could pass it on to you, I could pass it on, and then y'all could pass it on. So now we can be in the game. We can win now. Like, we can get in the game and close the gap between the haves and the have-nots. You know what I'm saying? So, some people want to know how to make money fast in the stock market. Yeah, you can make money fast in the stock market, but my thing is this: you can also drive your car fast, but you didn't start by driving your car fast. You have to start by learning how to drive with two hands first. And basically, what I'm saying is, you have to learn the basics of the slow money first. It's not even that slow. It's not even that slow, really. But it's slower. I mean, there's different. There's levels to this. It's levels to it. You heard me, Mel. There's levels. But if you want to learn how to get money fast, you first have to learn how to get money slow. You have to learn the basics, the simple terminology of different words. You have to learn that first. Then you can lean. Then you can drive with one hand. Like, we got to get the basics first. You know what I'm saying? So I got both games. I got the fast money and the slow money play, but both are good. But you also, what you want to do with your fast money, you want to put it in your long-term portfolio as well. Let me give you an example. 10 years ago, Tesla. I know y'all heard of Tesla. Tesla was $20 a share in 2010. I don't know what day it was this week, but now it's a $2,000 a share company. From $20 to $2,000 a share in 10 years. Now, some people may say 10 years is a long time, but I beg to differ, because I'm pretty sure a lot of my viewers been out of high school longer than 10 years, right? And I bet it feel like yesterday. I bet you can remember when you graduated like it was yesterday. So 10 years is not even that long. So just imagine how fast it seemed like you just graduated. That fast, a $20 stock went to $2,000. So that means if you had $10,000 to invest in 2010, that would be worth $10 million right now in a 10-year period. But see, a lot of people think 10 years is a long time. 10 years is not even a long time. This is what I'm saying. So there's levels to it. You have to learn how to drive with two hands before you can drive with one hand and lean. This is the basics. You have to learn the basics first. So yes, Tesla became a $2,000 company this past week. This is what I'm saying. Long-term stuff pays off. Yes, you can get money fast, but you got to learn the basics. You got to learn the basics. So like in the pandemic time, what, 3 months ago, stock market dropped like 33%, right? 3 months ago. And the economists is screaming that this has been the fastest recovery from a bear market in history. Like, it dropped 33% in March, and in 3 months, actually no, let me correct that. This is the fastest recovery since 1920. Now, I think 1920 was the Great Depression, but it usually takes 18 months to dig out of a bear market that we just experienced. It usually take 18 months. It took us like 3 or 4 months to not only come out of it and break even, but now it dropped 33%, now we're up 50. So it's 17% above where it was before it dropped in 3 months. So if you was buying stocks like I was telling y'all to do in March, you would probably done doubled your money by now. And depending on what company you invested in, you probably tripled your money in 3 or 4 months. So just take that in consideration. Like, this is the stuff we need to be up on, like, now. Like, time is of an essence. Like, when I speak long term, you don't want to be 80 years old just getting this game. You want to get, the sooner you start executing this, the better. The sooner your money can start compounding. Okay? So, now, what else we got? Oh, my question is, well, a lot of people might ask that are following the markets, can the markets keep going up with this valuation? Because as of right now, we're experiencing a new norm. A new norm is being exposed. Everything is shifted to technology. Everything. If it's healthcare, it has a technology arm to it. Like, if you're a grocery store, you need to have a technology arm to it, like some type of online presence, because people are not going into restaurants. People feel more comfortable picking stuff up, getting stuff delivered. So any companies that are showing that they're adopting to the new norm is what we want to be looking into. Anything in tech right now, anything in tech is where you want to be looking. What's the name? Just reported a super dope quarter. You got Home Depot, Walmart, Target. All these people just gave out a good earnings report and good guidance, or a look ahead into what their business is going to do, because they have a dope online presence. And that's what you want to be looking into, because we are in a new norm now. Everything is tech. We're doing home Zoom calls, people working from home, people need computers, internet service, cloud storage. We need all this technological infrastructure. All this is being infused into the companies that are already in existence. So if these companies that are on the stock market that are not transitioning into technological realm, their prospects and their outlook on the future is not good. So as far as what to be looking at, you want to be looking at anything that involves technology. Any dope company that is exhibiting transition into technology. So, what else? And some companies take this in consideration as well. Some companies are also worried about, they know that this past 3 or 4 months, like companies like Walmart, companies like Target, some of the ones I just named, Home Depot, a lot of these companies, they've seen that the past quarter, the past 3 months has been super dope for them, because everybody had this extra $600 coming in. They had $1,200. Everybody got $1,200 checks. So everybody, they know when they give you this money, they know that they done trained you to be a consumer to the point where they know what you're going to do with the money before they even give it to you. They already know you're a consumer. This is what they train the whole country, the whole world to be. Consumers. Spend your money. You know you got to pay rent. You know you got other important bills to pay, but Foot Locker gave us, they super beat expectations. Their earnings report was through the roof. Why was people buying sneakers? Everybody in the crib. You can't even go nowhere. Couldn't even really go nowhere for the past 3-4 months. But Foot Locker's numbers was through the roof. For one, everybody got $1,200 plus the extra $600 a week everybody was getting. And it's like, Foot Locker has an online presence. And it's like, yo, why are you buying sneakers? Like, why are sneakers so important right now when you're sitting at the crib? Because they know everybody is a consumer. This is why all these companies did super crazy numbers. And they don't know if it's going to continue because the $600 is going to stop. That's in limbo. They don't know about the next stimulus check. That's in limbo. So that's why the projections going forward into the next quarter are not so, what's the word I'm looking for? Not so optimistic. Because the stimulus check is, they still, the Democrats and Republicans, they still going back and forth whether they're going to give people some more money. So these companies know that the boom that they just experienced may not continue. Because we need some more stimulus for this to continue at these numbers. That's what I'm saying. Can these markets keep going higher? And that's what you got to keep an eye on this coming week. What are they going to do with the stimulus checks? Are they giving out more unemployment? Like, what's the unemployment check going to look like? Is it going to be 6? Is it going to be 5? Is it going to be 4? No one knows. So that's why these companies are like, Dad, we don't know if these numbers are going to keep booming like this this next quarter, because we don't know what's up the stimulus check. So keep that in mind. Moving on to the term of the week. Term of the week, y'all. Blue chip stocks. What is a blue chip stock, you might ask, right? What's a blue chip stock, $9? Blue chip stock is basically companies that are financially stable. These are stocks of companies that are financially stable and have shown over a course of a certain period of time that they are able to continue to pay dividends in good and bad economic times. And these are typically large cap companies. Large cap means large capitalization. You have different capitalization classes. And blue chip stocks, the ones that I just described, are usually large cap stocks. Now, large cap are companies that have a valuation of 10 billion or more. So these are big companies. These are dope companies. These are dope companies I've been talking about that you want to be looking into. Now, if you was buying stocks in March and April, like I was telling y'all to do, you would have been able to get these dope companies, these dope blue chip stocks for at least 30% off. At least 30% off. I heard somebody say that the stock market is the only store that people run from when there's a sale. It's funny, but it ain't funny. The stock market is the only store that people run from when it's a sale. Why? Because we don't know no better, right? And the more and more I dig in, the more and more I read and learn, they will tell you in all these financial books and all the commentary that it doesn't take rocket science to figure out the numbers of these companies. The furthest you'll go as far as doing math is division. What grade did you learn division in? What grade did you learn division in? 4th grade? 3rd grade? I done forgot. But that's the highest level of math you need to deal with stocks. That's it. And if you know how to read, you in the game. But yeah, you don't have to do no more than division, right? So it's not rocket science. Oh yeah, third grade. Now I'm live on Instagram. My YouTube fan, please feel free to tap into Rappin Dope on IG. RIPPIN_DOUGH for your daily, weekly business and stock market commentary. But yes, blue chip stocks, man. You would have been able to get those things for at least 30% off. At least 30% off. Like I said, it dropped 33%, and it's up 50% since then. So it's 17% above where it was before it dropped. So yeah, term of the week is blue chip stocks. Companies that are financially stable, that have shown over a period of time that they can continue to pay dividends in good and bad times. Like I said, those generally are large cap stocks. Those are companies that have a valuation of 10 billion and above. So that's your financial bars for this week. Keep investing. Keep putting your money to work. And let's keep running the bag up. You know what I'm saying? So we got a good week coming up. So with that being said, I'll see y'all next Sunday. Peace.